Okay, let's dive deep. We're looking at a really significant shift today.
Yes, a major forecast change from Goldman Sachs. Big implications.
Absolutely. We've got a stack of sources here, analyses, reports, all digging into their latest U.S. recession forecast, the data they're using, how it stacks up.
And the big headline everyone's talking about. Goldman has lowered their odds of a U.S. recession in the next 12 months. Pretty substantially.
Down to 30%, right.
That's the number, 30%.
Wow. That feels like a big drop. I mean, wasn't it 35% just recently?
Yeah.
And even higher before. Hatzius was talking 45% not that long ago.
He was, yeah. So this is a notable shift in their thinking.
But what's the main reason why this sudden optimism, relatively speaking?
Well, according to the analysis, the core driver is what they're calling lessened tariff policy uncertainties.
Ah, okay. So it connects to that recent U.S.-China trade agreement discussion.
Exactly. It seems they believe that agreement significantly reduces the uncertainty hanging over businesses and consumers.
So it's less about the tariffs themselves biting hard right now and more about the fear of what might happen next, lifting.
Precisely. Jan Hatzius, their chief economist, has argued for a while that the uncertainty itself was the real drag, more damaging than the actual price effects, which the sources call faint on the consumer side.
Right. The uncertainty messes with investment plans, hiring decisions, that kind of thing.
Exactly. So Goldman's revision suggests they think that particular drag has, meaningfully decreased now.
And this came out June 12th, led by Hatzius.
Correct. And it wasn't just the recession odds. They also nudged up their U.S. GDP growth forecast for 2025.
Oh, yeah. From what to what?
From a quarterly rate of 1% up to 1.25%.
Okay, so our mission for this deep dive is pretty clear then. We need to figure out why Goldman shifted, check if the actual economic data supports their view using all these sources you gathered, see how they compare to other big banks and forecasters, and crucially, translate this for everyone listening.
Right. What does a 30% chance of recession actually mean for you? Whether you're thinking about investments, your job, maybe taking out a loan, or just your day-to-day budget.
Let's start with Goldman's view in a bit more detail. What's underpinning that 30%?
Okay, so probability down from 35 to 30%. The key reason cited, again, is that reduced trade uncertainty. They're betting that removing that specific headwind is a significant positive.
And this optimism points towards a soft landing. That's the term they're using.
That's the scenario their forecast leans towards, yes. The idea that the economy cools just enough to tame inflation, but without crashing into a full-blown recession.
And what are the key pieces of evidence they're highlighting to support that soft landing view?
They point to a few main things. First, what they call labor market rebalancing.
Meaning it's slowing down but not falling off a cliff.
Exactly. Cooling but not collapsing. They highlight metrics like the job openings to unemployed ratio.
Right, I saw that in the notes. It's come way down from the peak.
Way down. Now, near pre-pandemic levels, around 1.03 jobs per unemployed worker as of April. That signals much less intense labor shortage.
And things like hiring rates, quit rates.
Those are moderating too. Fewer people quitting suggests maybe less confidence in finding a better job easily. But crucially, layoff rates are still low.
So the picture is one of gradual adjustment, not sudden pain, fits the soft landing idea. What else?
Second pillar is the inflation trajectory. Goldman seems pretty confident inflation is heading back towards the Fed's 2% target.
And why are they confident? Is it just wishful thinking?
Well, part of it is their assessment that the tariff impacts might be less severe than feared. And they see financial conditions easing back. Hatzius had previously said core inflation was probably heading to 2%, but warned new tariffs could delay that.
So now they seem less worried about that delay.
It appears so. They seem to think the path to 2% is clearer now, perhaps without needing the Fed to hike rates much more, if at all.
Okay, so labor market cooling gently, inflation heading the right way. What's the third factor? Resilient growth, adjusted for tariffs. That GDP forecast bump to 1.25% quarterly reflects their belief in some underlying economic strength once you account for the reduced drag from trade uncertainty.
So the narrative is, trade worries ease, job market finds balance, inflation cools, underlying growth holds up okay. Sounds almost neat.
It's a hopeful picture,
Yeah.
but we need to remember, even Goldman acknowledges 30% is still, as Hatzius put it before, about 35%, a sizable number.
Right. A nearly 1 in 3 chance isn't exactly zero risk. Significant uncertainty remains.
Absolutely. It's optimism, but cautious optimism maybe.
Okay, so that's Goldman's case. Now, the big question. Does the actual economic data, looking across all these reports, really line up with this relatively rosy view? Let's put it to the test.
Yeah, let's check the data, pillar by pillar.
First up, inflation. We got the May CPI numbers. Headline up just 0.1% month on month. That's 2.4% year on year. Core CPI, stripping out food and energy, also just 0.1% month on month, 2.8% year on year.
And the Fed's preferred measure, PCE, for April.
Also looking mild. Headline PCE up 0.1% month on month, 2.1% year on year. Core PCE up 0.1% month on month, 2.5% year on year.
Okay, so focusing on core, which the Fed watches closely as a better predictor, those low 0.1% monthly increases are genuinely encouraging.
Yeah, that does suggest the underlying trend is moderating.
It supports the idea that maybe inflation can get back to 2% without needing a really harsh economic slowdown driven by more Fed hikes.
But there's always a but with inflation, isn't there?
Always. You could still get shocks from food or energy prices, geopolitical stuff, but based on this data, the disinflation trend looks, well, intact for now.
Okay, so 0.1 for Goldman, maybe. Inflation data seems cooperative. What about the labor market? They need that gentle rebalancing.
Right. The May jobs report showed 139,000 non-farm jobs added. That's growth, but it's definitely a slower pace than we saw earlier.
Unemployment rate.
Held steady at 4.2%. Average hourly earnings up 0.4% monthly, 3.9% yearly. So, still some wage pressure, but perhaps easing slightly.
And didn't the reports mention revisions to prior months?
Yes, downward revisions, suggesting the job market was maybe a little cooler than we thought even in the previous months.
What about the JOLTS data job openings?
April JOLTS showed openings at 7.391 million. Still a lot, but way down from the peak. And the quits rate is interesting.
How so?
It fell to 2%. That's actually below where it was before the pandemic.
Really? Below pre-pandemic. What's that signal?
It suggests workers are much less confident about finding a new, better job quickly. Less job hopping. Layoffs remain low, though, just a tiny tick up.
Okay, so putting the labor pieces together.
It really does seem to fit that rebalancing narrative Goldman is talking about. The openings to unemployed ratio falling so much confirms shortages are easing. Falling quits confirms workers feel it, too.
So this could support a soft landing if it continues smoothly.
Yeah.
Easing wage pressures without mass job losses.
That's the potential path, yes. So the labor data also seems somewhat aligned with Goldman's view. Maybe 0.2 for Goldman?
Okay, inflation looks okay. Labor market looks like it's rebalancing. But now, growth and consumption data. This seems like where the story gets tricky.
Yeah, this is where the optimism really bumps up against some harder numbers.
Let's start with GDP.
Yeah.
That Q1 number. It was negative, right?
It was. The second estimate for Q1 2025 GDP showed the economy contracted at an annual rate of minus 0.2%.
Minus 0.2, even revised up slightly. That's still negative growth. A huge change for the end of last year.
A massive swing from Q4 2024's plus 2.4%. Now, the sources say imports and government spending were big factors, but still, a negative print directly challenges the idea of resilient underlying growth.
Yeah. Hard to spin negative GDP as robust. What about the consumer? They're the engine of the economy.
Retail sales data for April showed only a tiny 0.1% increase month over month. Year over year is still up over 5%, but that monthly number shows very little momentum.
Barely moving. And consumer confidence.
Really low. The University of Michigan index in March was down at 57.9. That's the lowest reading since November 2022. People are not feeling great about the economy.
So consumers are feeling gloomy? They're barely increasing spending month to month, and the overall economy actually shrank in the first quarter. That sounds pretty weak.
It absolutely does. It paints a picture of slowing momentum and caution, directly contradicting the more optimistic growth takes. This is a significant hurdle for the soft landing narrative.
Okay, so growth and consumption data look like a point against Goldman's optimism.
Yeah.
What about leading indicators? Things like the PMIs.
Also concerning, the ISM Purchasing Managers Indexes for May. Manufacturing was 48.5. Anything below 50 means contraction.
So manufacturing is shrinking. What about services? That's been the stronger part.
Services slipped too. It came in at 49.9, also just barely into contraction territory.
Wow, both manufacturing and services contracting.
Yes. That signals the slowdown isn't just isolated, it seems pretty broad-based across the economy. More evidence of losing steam.
Okay, one more indicator people watch closely, the yield curve. What's happening there?
Well, as of mid-June, the curve was actually positive again. The 10-year Treasury yield was about 0.46% higher than the 2-year yield, so no longer inverted.
It was inverted for a long time, though, wasn't it? July 22 to August 24.
Yeah, a prolonged inversion. And historically, that inversion has been a pretty reliable recession predictor.
So the fact that it's positive now means the recession risk is gone? All clear.
It's not quite that simple. There's a lot of debate, as the sources point out, about whether the signal is distorted this time. Because of the weird post-pandemic inflation, the Fed's aggressive hikes.
Right. Maybe it's different this time. Famous last words.
Could be. But crucially, some analysis suggests that the curve uninverting can sometimes happen right before a recession starts. And models like the New York Fed's, based on that yield spread, were still showing pretty high recession odds, like 50 to 75% as recently as April.
So even a positive curve doesn't completely erase the warning signal from the previous inversion of those models. Still a bit murky.
Exactly. The yield curve picture is complex right now, not a clear green light.
Okay, so let's sum up the data check. Inflation and labor markets. Maybe leaning slightly towards Goldman's soft landing view, if the trends hold. But growth, consumption, the PMIs showing contraction, and even the yield curve picture. They all look much weaker, casting some serious doubt on that optimism.
That captures the tension perfectly. Some data supports the hope, other data flashes warning signs. It's a mixed bag.
So, given this mixed picture, how does Goldman's relatively optimistic 30% call compare to what other big players are saying? Are they outliers, or is everyone feeling better?
Well, there's definitely been a broader shift towards lower near-term recession risk, largely tied to that trade news, but Goldman seems to be on the more optimistic end of the spectrum, especially regarding growth.
Let's look at some other major banks. What are Morgan Stanley saying?
Morgan Stanley, in late May, also expected a slowdown but thought recession would likely be avoided. Their growth forecast was 1.5% for 2025 overall, but that implies only about 1% growth Q4 over Q4. Like Goldman, they cited policy uncertainty and tariffs as drags. They see the Fed holding off on cuts until March 2026.
Okay, so avoiding recession, but slower growth than Goldman's 1.25% quarterly implies. What about JPMorgan?
JPMorgan also cut their risk significantly in late May from 60% down to 40%, and they explicitly tied it to trade de-escalation, just like Goldman.
So similar reasoning, but 40% is still higher than Goldman's 30%.
Right, and their growth forecast is much more subdued. They expect only 0.25% annualized growth in the second half of 2025. Very weak. They also see Fed cuts waiting until December 2025. It's interesting. Their earlier 60% risk was blamed on disruptive U.S. policies.
And Bank of America? Any different?
Buffett sounded quite optimistic in early June. They expected to avoid recession, talking about the economy's remarkable resilience, consumer spending, and the labor market holding up. Maybe closer to Goldman's tone?
Okay, so it seems like the trade news prompted most banks to lower their immediate recession fears. But there's a real split on how much better things look, and especially on how strong the underlying economy is going forward.
Exactly. Agreement on less trade shock risk, disagreement on fundamental strength. Goldman's 1.25% quarterly growth looks quite a bit stronger than what Morgan Stanley or especially JPMorgan are projecting.
What about official bodies like the IMF or World Bank?
Yeah.
And the rating agencies? Do they buy into the optimism?
Generally, they seem more cautious. The IMF in early June actually saw recession likelihood climbing to 40% and cut its U.S. growth forecast to 1.8% for 2025. They specifically flagged tariffs and trade tensions as major risks.
40% from the IMF. That's definitely more worried than Goldman.
Yes. And the World Bank, around the same time, cut their U.S. growth forecast even further, down to 1.4%. Again, citing tariffs and uncertainty hitting business investment.
So these international bodies seem less convinced that the trade situation is fully resolved, or at least they see the existing barriers, not just uncertainty, as a continuing drag on growth. More pessimistic than Goldman.
That's the takeaway. They emphasize the friction and cost of the trade barriers themselves. And even the Fed, as we know, is staying cautious, acknowledging risks on both sides, inflation and growth. They're in wait-and-see mode.
And rating agencies like Moody's or S&P.
Moody's, back in May, saw growth cooling to 1% but likely avoiding recession. Their model showed about a 22.6% probability then. S&P Global just recently projected growth ending 2025 at the slowest pace outside a recession since the early 90s. They even see domestic demand potentially contracting in the second half of the year.
Wow. Contracting domestic demand, that's pretty grim.
It definitely contrasts with Goldman's view. So while the trade news was a positive catalyst across the board, Goldman's overall forecast, especially on growth, really does stand out as being on the more optimistic side compared to many international bodies and even some rating agencies.
Okay, so Despite the reduced headline risk from Goldman and others, there's clearly still a strong bear case out there. Why do some analysts still see significant recession risk? What are they focused on?
The bears are looking at factors they believe haven't gone away just because of one trade agreement. First, the classic argument, lagged effects of Fed tightening.
Right. The idea that we haven't felt the full impact of all those rate hikes yet.
Exactly. Monetary policy takes time to work through the system, sometimes 12, 18 months or more. The full squeeze might still be coming.
Makes sense. What else?
Persistent trade policy uncertainty and stagflation risk. They argue that one deal doesn't mean the broader trade and geopolitical environment is stable. There's still tension. And organizations like the OECD projected a kind of stagflationary outcome for the U.S. slower growth, around 1.6%, but still high inflation near 4%, partly due to tariff impacts.
Stagflation, slow growth and high inflation. That's the worst of both worlds.
It really is. Then third, they point squarely at the weakening economic data we just discussed.
The negative Q1 GDP, the contracting PMIs, the weak retail sales, the low consumer confidence.
Exactly. Bears see this not just as noise or vibes, but as tangible evidence the economy is already stumbling.
And the yield curve, still a concern for them.
The yield curve's lingering shadow, yes. Even though it's positive now, that long period of inversion historically sends a strong warning. Plus, those NY Fed models still showing elevated probability based on the spread. They don't dismiss that signal lightly.
Are there any specific weak spots in the economy they highlight?
Yes. Consumer and business vulnerabilities. They worry about things like rising credit card debt and delinquencies, stress in commercial real estate spilling over, and particularly small businesses struggling.
Small businesses getting squeezed.
Right. There were warnings cited, like from Apollo, that tariffs could hit small businesses hard, leading to failures and layoffs, potentially taking a chunk out of GDP growth. These vulnerabilities could make the economy less resilient to shocks.
So the bear case is basically, don't ignore the lagged policy effects, the ongoing trade friction, that's the tangible weak data, the yield curve's history, and these specific vulnerable spots. A trade truce doesn't magically fix all that.
That sums up their perspective pretty well. They see underlying weaknesses that persist.
Okay, we've unpacked Goldman's view, stress-tested against the data, compared it to others, and heard the bear case. Now let's bring it home. What does all this mean for you? How does Goldman's 30% forecast translate into real-world implications?
Right, let's connect this to personal finance decisions.
Okay, first up, for investors. If a big player like Goldman says recession risk is lower, what does that usually imply for markets?
Typically, lower perceived recession risk is good for risk-on assets. That means stocks, especially cyclical stocks companies whose fortunes rise and fall with the economy, and maybe small-cap stocks.
So is it time to pile into the stock market?
Well, it's not necessarily an all-clear, full-speed-ahead signal. Remember the mixed data and the other, more cautious forecasts. Volatility is still very possible if inflation stays sticky or growth weakens more than Goldman expects.
So caution is still needed. What about defensive stocks?
Defensive sectors could still play a role. If the landing is bumpy or if Goldman's optimism proves misplaced, those steadier stocks offer some protection. Diversification remains absolutely key.
And bonds. What's the thinking there?
If inflation keeps cooling and the Fed eventually does start cutting rates, even if it's later, like 2026, as some predict, that would likely mean bond yields moderate or fall, which pushes bond prices up. So potentially positive for bonds down the road.
So for investors, the takeaway seems to be maybe a slight gradual tilt towards riskier assets if your personal situation allows it, but don't abandon diversification. Maintain balance given the uncertainties. This fragile optimism, as you called it, doesn't warrant huge bets.
Exactly. A balanced portfolio aligned with your goals and risk tolerance is still the prudent approach, especially for those closer to retirement.
Makes sense. Now, what about for employees and job seekers? What does a 30% recession risk mean for the job market?
Generally, it's a positive signal for job security compared to, say, a 60% risk scenario. If the labor market avoids a sharp downturn, like Goldman expects, layoffs should remain relatively contained.
Does it mean it's easy to get big raises again?
Maybe not like the peak frenzy, since the market is cooling, but with wage growth still around 3.9% year over year in May, and if inflation keeps moderating, you might see some growth in real wages. So there could still be some room for negotiation, depending on your role and industry.
Speaking of industries, are things looking better in some sectors than others?
Definitely. The sources highlighted continued strength in hiring for healthcare, social assistance, transportation, warehousing, but weaker trends in information manufacturing. And we saw those federal job losses recently.
So knowing your specific sector's outlook is really important.
Crucial. The overall picture might be okay, but your specific situation could vary a lot.
Okay. Next big area, for borrowing and credit. If recession risk is lower, does that mean interest rates are coming down soon? Mortgages, car loans?
It's all tied to the Fed, really. Lower recession risk might mean the Fed feels less pressure to cut rates quickly to stimulate the economy. If inflation cools gradually, rate cuts are still expected by analysts, but maybe later, late 2025 or into 2026 seems to be the consensus.
So borrowing costs could decline, but slowly.
Gradually seems like the right word. For mortgages, many forecasts see rates maybe drifting down modestly through 2025, perhaps into the 5.5% to 6.5% range. Lower, yes, but still way above the lows we saw a few years ago. Some analysts even think they might stay mostly flat.
So no return to 3% mortgages anytime soon.
Doesn't look likely based on these forecasts. And similar story for things like auto loans. No dramatic drops expected this year.
So if you're thinking of borrowing or refinancing,
It really depends on your individual situation. Waiting for significantly lower rates might mean waiting a long time. Consolidating existing high-interest debt, like credit cards, might be a more immediate benefit. And, as always, working on your credit score gives you the best chance at better rates, regardless of the overall environment.
good advice. Finally, for general consumers and spending, how does this filter down to household budgets and decisions?
Well, the disinflation part is helpful. Prices rising more slowly eases the pressure on budgets, assuming your income is stable. It's not deflation, prices aren't falling, but the squeeze is less intense than it was. Your purchasing power erodes less quickly.
Okay, that helps day to day. What about bigger decisions? Buying a car, a house, planning a big trip? Does lower recession risk make those easier?
It adds a layer of confidence, perhaps, less fear of imminent job loss for many. But borrowing costs are still high, and as we've seen, overall economic uncertainty hasn't vanished.
And consumer confidence is still really low.
Exactly. Low confidence and those weak retail sales figures suggest many people are already being cautious, despite the headlines about lower recession risk. So for big-ticket items, it's still complex. A wait-and-see approach might still feel prudent for many, especially if their job isn't totally secure or they're just worried about the lingering risks we discussed.
So even with Goldman's improved outlook, caution seems to be the watchword for many consumers.
It reflects that gap between some expert forecasts and how people are actually feeling and behaving.
Okay, let's try to synthesize all of this. Bring it all together.
Right. Goldman Sachs cuts its U.S. recession forecast to 30%. Big reason. Reduced uncertainty around trade policy. This supports their view of a possible soft landing, where the labor market rebalances gently and inflation cools without a major crash.
But as we dug into the sources, that view looks pretty optimistic compared to many others.
Yes, especially compared to international bodies like the IMF and World Bank, who see lower growth and emphasize the ongoing drag from trade barriers themselves.
And crucially, Goldman's optimism clashes with some key pieces of recent economic data.
Definitely. The negative Q1 GDP, the contracting PMIs in both manufacturing and services, the really weak consumer sentiment, the sluggish retail sales, those numbers paint a picture of an economy that's slowing significantly now.
So Goldman's forecast seems to depend on a lot going right from here. Trade stays calm, inflation keeps falling smoothly, the labor market executes a perfect gentle landing.
It feels like threading a needle, as one analysis put it, a delicate balance. Plausible? Maybe. But fragile given the headwinds and the more cautious views elsewhere.
And we can't forget the risks lurking out there, the potential black swans or just known unknowns.
Absolutely. A resurgence in inflation is always a risk. Maybe new tariffs, maybe energy prices spike due to geopolitical events, maybe supply chains get tangled again. Hatzius himself warned tariffs could delay disinflation. Geopolitical flare-ups beyond trade, military conflicts, instability, policy uncertainty from potential administration changes, unexpected adverse economic shocks, maybe a worse global slowdown, problems in China's economy, or hidden financial vulnerabilities surfacing, like in commercial real estate or shadow banking.
And of course, policy missteps, the Fed getting it wrong.
Right. Hiking too much or for too long, or cutting too soon and reigniting inflation, or even disruptive fiscal policy decisions, all potential derailers.
And these risks are interconnected, right? One thing can trigger another.
For sure. A geopolitical shock hits energy, boosts inflation, forces the Fed to tighten, hurting already cautious consumers and vulnerable businesses. It can cascade. That web of risks makes judging that 30% probability really challenging.
Okay, so the executive summary. Goldman sees 30% recession odds, driven by trade certainty hope. But it's an optimistic take compared to many, and it jars with some weak current data. Big uncertainties remain around trade, inflation, and that labor market rebalancing act, for you, the listener. Maybe cautious optimism for investments, a generally okay but sector-dependent job market, high borrowing costs that might ease gradually, and some relief from slower inflation, but maybe still a time for caution on big spending given low sentiment.
It really boils down to cautious optimism. Navigate moderate growth, navigate uncertainty. Don't assume the coast is clear, but maybe the immediate storm risk has lessened in their view. Vigilance and adaptability are still the name of the game.
Which leaves us with a final thought to chew on. Goldman Sachs, a major voice, sees only a 30% chance of recession, banking heavily on trade peace. But we've seen how that clashes with other forecasts, and maybe more importantly with some really weak spots in the current economic data.
Right, the optimism hinges on future improvement and downplays some current negative signals.
So, given these conflicting signals, the optimistic forecast versus the cautious data and other experts, plus all those potential risks still swirling, how do you, personally, weigh that 30% probability when making your own significant financial decisions? What signs or data points will you be watching most closely now to gauge if we're heading for that soft landing or something bumpier?
Lots to think about, and definitely worth staying informed as the data continues to roll in.
Absolutely. Thanks for joining us for this deep dive.